Hello and welcome to Market Domination. I'm Jared Blikre, in for Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are in rally mode. Check out the Dow crossing 50,000 for the first time. It is up 2.24%, leading the way, up quadruple digits, over 1,000 points. S&P 500 trailing at 1.7%, and the Nasdaq Composite right there in line with it. But let's get over to Ines Ferre, who is standing by with the headlines. Ines, 50,000. I thought this day would never come.
That's right. What a difference 24 hours makes. I mean, it looked like the sky was falling at one point, and now look at this. As you just mentioned, 50,000 for the Dow. The Nasdaq Composite is up 1.7%. The S&P 500 also seeing a nice rebound, 1.71%. Just taking a look at the sector action. Wanted to mention the sectors that are leading right now is technology, industrials, energy. There has been a bit of a broadening out of this rally that we've seen. So take a look at the Dow right now, 50,000 on the Dow, yet you still have Amazon that's down more than 7%. So you've got the Dow that's at a record despite one of the Mag 7s that's in the red. Also on the Nasdaq 100, take a look at Google is down at more than 2%. Meta is also lower, but you've got Nvidia that's surging up 7%. Broadcom, the semiconductor chips are in the green. Also, we have been looking at software stocks because these have been getting a hit recently today. A nice bump that we're seeing with some of these software stocks, but also Bitcoin. Yesterday, Bitcoin was down 13%, the worst day since 2022. Now take a look, above 70,000 right now. I mean, Bitcoin over the last 24 hours has pretty much made a move from the lows of 61,000 to 70,000. So quite a rebound that we've seen there. And then just taking a look at gold, we have seen gold edging higher, up near 4,900 per ounce, and silver even seeing a bit of a bump today as well.
Thank you for that, Ines. And let's get right into it. Many investors jumping right back in after the volatility this week. But what should you do now? Joining me now is Emily Roland. She is a Manulife John Hancock Investment Co-Chief Investment Strategist. Emily, thanks for being here with us. So what do we do now? We could buy the dip, but then the question is, what dip? Obviously, software is down big. S&P 500 and Dow having their best day since May of last year. Dow over 50,000. S&P 500 almost back at records. What do you do?
Yeah, Jared, I think we did miss that opportunity to buy the dip. You know, clearly that mentality here is alive and well. And one of the more healthy things about this market, as you all just pointed out, is the breadth that's emerging. We're, looking at sector participation that's increasing. We've been advocating for areas like industrials, which are sort of our favorite cyclical part of the market. Those stocks doing well. Financials seeing outsized earnings results for the fourth quarter. So we like the breadth that's pervading markets here. Certainly tech here taking a little bit of breather. I would say that's not totally surprising, given that the valuations were pretty egregious in this space. So I think just sort of a healthy breather here for the technology space, but some nice participation across other areas of the market.
Yes, I know you've been hot in the industrials, and they've been doing very well this year. Caterpillar hitting a record high today, I believe. And even the Dow Industrials and both the Dow Industrials and Dow Transportation indexes have both been hitting record highs. So there's your Dow theory. But what do you do with tech? Is it time to step in? Do you buy some of these software names? Have we seen the capitulation, or you just say, all right, I'm going to hold off and wait a little bit?
Yeah, look, I mean, these are the best companies in the world right now. A lot of these businesses are so solid. They have great balance sheets. They have great return on equity, really high quality, great, earnings growth prospects. The challenge is that portfolios have gotten so much out of the technology space. It's been an asset allocator's dream return driver. And you have this environment now where consumer net worth right now is $173 trillion. And for the first time since the late 1990s, consumers own more stocks than they do real estate. So you've seen this massive appreciation, primarily driven by AI and tech, that's contributed to this over concentration in stocks and in tech primarily. So we still like it. tech, is still attractive to us, but we really want to think about rounding that out, which is why we're using the mantra quality at a reasonable price, or quality value right now in portfolios. And again, that's a function of that sort of broadening out that we're seeing. We like mid-cap stocks here as a diversifier from that tech space. When you go down in market cap into mid-caps, you're still getting high quality. You're getting a very different sector composition. You are going to get more of those industrial stocks. You might get some more financials, regional banks right now benefiting from M&A activity. So it's kind of like that go-to outfit in your closet. I don't know if you have one of those.
I'm wearing
that's
it. You kidding me?
That's technology stocks to us. And we don't want to necessarily get rid of that go-to outfit, but we want to sort of think about rounding the closet out.
All right,
now.
Let's talk about the economic data that's coming in. We're looking ahead to the big monthly jobs report next week, along with inflation, CPI. This week was not the greatest on the labor front, and I know you're writing that the run it hot story by the Fed, that is run the economy hot, cut rates, whatever, might be a mirage. So talk to us about that.
Yeah, there's this idea that the economy is really heating up here, and we don't see it as being that hot. In fact, some elements are pretty cool right now. Yes, there was a beat in the ISM data, both on the manufacturing and the services side. But if you look at the labor market, it was not great this week. You saw the biggest number of layoff announcements from Challenger in the month of January ever. We've seen job openings slow to the lowest level since 2017. So we are seeing pressure. Of course, we had those 3 negative jobs reports. There is some noise around that given the government shutdown and federal employees. We're going to get another labor report next week, which we'll be watching closely. The breadth hasn't been there as far as the job gains. They've all been driven from healthcare. And then we're also watching some disinflation coming from the housing market. Trueflation right now has inflation below 1%. So all of this, what it means for portfolios is we actually think that rates are not sniffing this out. We think bond yields can come down and investors can benefit from the income that's available on high quality bonds today.
Let's stick with bonds here, because I was watching the price action this week, and when stocks were nosediving a couple times this week, but also especially yesterday, we did see this flight into quality. That is, we saw bond yields ticking down as bond prices were going up. That means investors were going to that. And that was a departure from what we saw in April of last year when it was sell America, including the bonds and the dollar. It was nice to see that, but talk to us. So you like treasuries as opposed to corporate, or just kind of explain your reasoning there?
Yeah, that was really nice, wasn't it? Like everything we ever learned in the textbooks, like actually worked, which was nice. Same thing with the dollar. So we really like high quality bonds in general. It's investment grade corporate bonds, or about as much risk as we want to take here. We like the elevated income that's available in high yield bonds, but we just don't see the fundamentals being attractive with credit spreads as tight as they are today. So it's mortgage backed securities, it's treasuries, it's investment grade corporate bonds, it's municipal bonds. Basically anything boring is what we like right now, because the yields are elevated. The 10-year treasury yield is still above 4%, which we think is pretty unusual in an environment where there is moderating inflation, where there is a weaker labor market. The bond market just hasn't sniffed that out right now. Bonds are kind of dazed and confused. They don't know where to look. They're thinking about what's going on with Japanese bond yields. They're thinking about the implications of a Kevin Warsh as a Fed chair. So there really has not been a focus on the macro picture. We think once bonds sort of come out of the fog of confusion, they're going to refocus on what matters, which is inflation and growth moderating. That brings bond yields down. It allows the Fed to cut, and it benefits you as a fixed income investor.
In your notes regarding bonds, you say it's complicated. I like that. Let's stick with boring. Last question here. We saw in January some of the more boring sectors, the defensive sectors like staples, healthcare, utilities, even real estate, kind of come alive. And you could throw energy in there too. What do you think about that? Is there a more defensive posture in the market right now? Is that saying anything concerning?
Yeah, we've been overweight utilities, and of course, that's also a play on AI and all the build out around data centers and the demand there. Another area that we've been emphasizing is infrastructure stocks. This is the stuff that people need versus the stuff that they want. We think that we've had an incredible run for risk assets here, 3 back-to-back double-digit returns for riskier parts of the market, for the market broadly speaking. So thinking about something more defensive here here, whether that's those traditional dividend paying sectors, although the dividend yield on the S&P 500 is at a record low at 1.1%. So you want to be thoughtful there, but leaning into those more defensive areas, utilities and infrastructure among our favorites.
Emily, lots of great insights there. Thank you so much for joining us.
Thank you.
And coming up, we are tracking the crypto action as Bitcoin rebounds. The host of the Wolf of All Streets podcast, he joins me next. Shares of Stellantis cratering as the company switches gears on its EV business. Yahoo Finance's Praz Subramanian joins us now with the details. Praz, I had to do a double take. Over 20 billion euros in charges, 6.5 billion in cash out over 4 years. By the way, no dividend this year, and the stock is trading like a penny stock. What's going on?
Yeah, Jared, I think that stock move is showing you that it really caught investors and us in the sort of the reporter community by surprise, right? So you note a $26 billion U.S. charge stemming from that EV pivot. It follows Ford and GM here doing the same thing, but not to this extent. $7.7 billion in U.S. dollars. That's a cash payout over the next 4 years, and a $17.34 billion non-cash charge hitting the balance sheet for second half 2025 results. So like I said, they're canceling upcoming EVs. They're canceling some current EVs that are in the market, not necessarily here, but also in Europe and other places. The market. So basically, the gist of it, the market just isn't there for Stellantis' vehicles, right? The EVs they have on offer, and they're even late to come to the game in terms of what they're doing. And they still took a massive charge here. So you're going to pivot more to gas and gas-powered cars and trucks, also pivoting to more U.S. manufacturing. That comes as the Trump administration brought back some of those these gas emissions standards and wants to encourage more U.S. production. So that's what we're seeing here. The other big issue that Stellantis has is the product portfolio. Ram is doing quite well with the pickups, but Jeep has taken some big hits recently. Dodge essentially just 2 vehicles, and Chrysler is 1. So the concern here for investors, yeah, you took a big charge, but do you have the products to sort of surmount that?
Yeah, lots of surprises and lots of resets in the EV world. Thank you for that, Praz.
Thank you.
And Bitcoin also seeing a nice rebound in Friday's action, but still trading well below the all-time highs after getting cut in half. Joining me now is Scott Melker. He's the host of the Wolf of All Streets podcast. Scott, thanks for joining us here. All right, are we calling this a dead cat bounce? I think what a lot of investors, a lot of traders, a lot of holders want to know is, when do we see this bottom? Do you think there's a cycle in play, the 4-year cycle?
Well, if anybody has a crystal ball that works better than mine, they can send it over, because I'm not quite sure if it's dead cat bounce or the bottom. But to me, this does feel like it could be a bottom, and there's a number of reasons for that. Technically, a lot of people are looking at the 200 MA on the weekly chart, a line that's been visited every single time the 50 MA is broken in a bear market. That's at about 57, 58,000 right now. The monthly 50 MA is there. Yesterday, we saw major capitulation volume, systematic selling all the way down to the close. But today's volume is actually going to close higher on the buy side than all of yesterday's sell volume combined. And across the board, not just on Bitcoin, across the crypto market, we're seeing some bullish engulfing candles, some beautiful potential bottoms being put in. So I think that we saw bearish euphoria at a fever pitch yesterday, and now we're probably going to be heading up, barring any major black swans. As for the 4-year cycle, I'm in the camp that the 4-year cycle is over, if it was ever there in the past. We do have one data point for people who believe, which was that the all-time high would come in October, but nothing else about this cycle has looked like the past. There was really no movement across the crypto market beyond Bitcoin or anything that had an ETF. And we had an all-time high way too early because of the approval of the ETFs. Really just doesn't feel like the same cycles as we had before.
That was kind of my thought last year. I was asking a number of guests in 2025. We have the most bullish regulatory backdrop for Bitcoin or crypto that I think you could ever have, and we still saw things kind of peter out a number of times. I thought the gain should have been bigger given the backdrop. Does crypto need a new narrative beyond Web3 here?
I don't think that it needs a new narrative. I think that the best narrative for Bitcoin is always higher prices. Unfortunately, Bitcoin starts to go up.
That takes money.
Retail gets very excited. It does, but it's not very hard to push this market around. To your point about the environment, yes, we have a very favorable legislative environment. We have a very favorable regulatory environment. Obviously, the pendulum has swung massively from the contentious environment that we had with the previous administration. But that said, I think all of that was effectively priced in at the moment that Donald Trump was elected. And so it's not that crazy that prices are now trading back to the same area that they were at that point. Also, with the election of Donald Trump, there's a bit of a push and pull. I think a lot of people very unhappy, and it's become politically charged that his family and himself are so involved in the industry itself that has become a bit of a political talking point yet again for the quote unquote anti-crypto army. So I don't know what the next catalyst will be, but I do know that Bitcoin is becoming massively institutionalized. You have news from every single wirehouse, every large institution about their participation in this industry and the unlocks and the incredible volumes of the ETF. So this is one of those times when prices have been beat down, sentiment is low, but there's crazy fundamental news that should be driving price up. And we're going to look back in a few months and go, wow, those news events were absolutely huge. We should have been paying attention.
So Bitcoin usually gets almost all the headlines, especially when it comes to mom and pop investors. And there's been all kinds of stories on the institutionalization. People can buy them in their 401ks. But what about some of the altcoins? And what about Ethereum itself? If we can go to the Wi-Fi Interactive, I have our cryptocurrency heat map here, and it shows the year-to-date performance. So here's Ethereum down 31%, Bitcoin down 20%. If I sort by performance, the final row here, I mean, it gets all the way down to 50%, and we're only in February. Do some of these altcoins have a chance of coming back, even if Bitcoin manages to do so?
Many of them absolutely do, but I have a haunting feeling that we're going to be in a world of have and have nots. And the haves are going to be those that have ETFs, treasury companies, some level of institutional adoption, institutions actually using their blockchains for various purposes. And the have-nots will be those that are left behind only to be traded by retail on crypto native exchanges that institutional investors don't have access to. So I would keep a very close watch on that. I mean, right now, obviously, Bitcoin, Ethereum, Solana, XRP, and others have ETFs or have narratives like that have compelled them to have higher prices than many others. I don't think we see, for those who have been in crypto a while, we used to have what we like to call an alt season where altcoins just go absolutely crazy. You talk about 10, 50, 100 X's, and you throw a dart and the next one goes. I don't think we ever see that again. I think we're going to actually have to look at utility and fundamentals and valuations like with other markets. But I do think that a lot of those tokens will do exceptionally well.
And what about the Bitcoin treasury companies and the other treasury companies that might have Ethereum? MicroStrategy, of course, Michael Saylor's strategy is the biggest, most famous of them. What happens to them? Obviously, higher prices, record highs would kind of cure the situation, but the strategy itself has taken a beating, and it's kind of been a high beta play on Bitcoin. Does it lose that edge? Does it regain it with higher Bitcoin prices? How do you see that playing out?
Volatility to the upside would be exceptionally good for MicroStrategy or Strategy and probably other treasury companies. That said, I've told this story many times, but I went to the Bitcoin conference in Las Vegas in May, and I was pitched 7 Bitcoin treasury companies in the first 5 minutes I was there. And I became probably the most aggressively outspoken voice in our industry against the idea of the treasury companies. I said they would likely be a bubble. They would be the reason for the next Bitcoin collapse. I didn't necessarily expect it to happen so fast. But that's one thing that had my spidey senses tingling from the very beginning. I think that there's room for MicroStrategy. There's not room for many more, right? And Bitcoin itself is a very hard asset to use to beat using Bitcoin. It actually intellectually makes sense for an Ethereum or a Solana treasury company because they can stake in the network, earn a yield, and then they can actually beat the performance of that underlying token. You can argue whether that token should be a treasury asset or not. That's not for me. I believe Bitcoin should. But I was always a big fan of a company taking their actual profits and cash flow and putting some of that into a Bitcoin as a hedge against the losses on their cash. But actually financially engineering around Bitcoin, Saylor can do it, but I'm not sure anybody else can.
All right, circling back to the beginning here, we're talking about the bottom, at least the tradable bottom that we have right now. Does it lead to more selling in a few weeks? We don't know, but you sound kind of bullish. So give us your bear case for 2026. How does that play out?
I think the bear case is that Bitcoin continues to drift lower. There's really no meaningful catalyst. And honestly, at this point, I think the biggest bear case for Bitcoin is if the stock market goes over, right? I mean, I think we could all take a look at stocks at the current valuations and people are scared. We had this interesting moment a few weeks ago where the stock fear and greed index was at extreme fear with stocks 2% off all-time highs, right? So people are very scared, even though stocks are very high. So I think we see some black swan event, all correlations go to one, and everything goes down together. That said, when's the last time that happened? March of 2020, right? Bitcoin dropped from 6,000 to below 4,000 in a matter of hours on March 12th with the COVID scare. 13 days later, I believe the stock market bottomed. Well, the stock market pulled a cute 2x from there, and everybody talked about how amazing that stock market was. Bitcoin went up 17 times. So if we do see an event like that, what asset do you want to be in for the inevitable ascent out of that hole? So I am very bullish on Bitcoin here. I see a lot of reasons for it to go up. I think that the selling has reached capitulation and irrational euphoria, as I said, and I'm very bullish.
Scott, it's been great talking with you. Thank you for all your insights here.
Thank you.
And coming up, shares of Affirm under pressure after the buy now, pay later company posted earnings. A conversation with CEO Max Levchin. Straight ahead. Buy now, pay later platform Affirm points to a healthy consumer as it delivers a sales beat for the second quarter and 23% active consumer growth. Yahoo Finance's executive editor Brian Sozzi sits down with the Affirm CEO Max Levchin for more on this quarter in this earnings breakdown brought to you by EY.
Max, good to see you. You had a lot of stuff going on this quarter. New partnerships, new deals. What worked really well for the company?
Without full sense of modesty, everything. I think we had a killer quarter. It's a 5th out of 5 in a row where we exceeded expectations set upon us by the street and ourselves. And so we're feeling very good about the results. Growth was super strong, 36% year over year. Just volume of our merchants, new record highs in revenue. First quarter of $1 billion plus in revenue. Highest number of active merchants, grew 42% year over year. I think it's a maybe singular record of that type of growth. Consumers at 26 million. So every single operating metric of the company is just really, really good.
You and I have talked a lot, and really there's been, especially over the past year, there's just been, seems like this upswing in your business. Like everything that you've been working so hard on has started to click. As you digest, as you look at the numbers in your business, is there one area in particular that is working really, really well right now?
Again, it's hard to separate a thing without feeling like you're besmirching some other metric that's just, every one of them has done really well. I would say the card that we launched a couple of years ago, for a time people are writing, they talk about the card, but will this thing ever really grow? Is undoubtedly a huge part of the growth. If you look at just the sheer shape of the curve of card actives and volume on the card, it's bending up in an exponential fashion. It's growing 5 times faster than the rest of the business. It's now really hitting its stride. It's north of 3.5 million active card holders in the quarter. So we're doing really, really well with that product. But again, it's a little bit unfair to single the card out, given we just announced a whole slew of really strong new partnerships. We are heading into helping services that are on QuickBooks Finance, or helping their customers finance various service orders. It's a bunch of initiatives we're doing in helping merchants promote their sales. We had the Big Nothing, the 0% APR days in October. We had a huge Black Friday, Cyber Monday period. So just every part of the business is really firing on all pistons. And I think, for lack of a better explanation, the team has been just getting better and better at executing. And, as a business that's still very high growth, but maturing, it's kind of a pleasure to see.
I still remember when you launched the cards, not to date ourselves, but time moves fast in these fields. What's next on the card front for you?
There's a lot. We think there's opportunity to bring even more of the thing that we're famous for. At this point, something like 39% of our transactions are interest-free because the merchants are subsidizing them. The best promotional tool, I'm biased, but it really is true, is to just offer consumers 0% loans. We're bringing more and more of that onto the card. We're offering some special card-specific things, so you can find them in our app all the time. We're going to do more events that are card focus, just bringing more and more value to our consumers so that our merchant partners can have more sales. That's sort of the main thrust of the card. But over time, we expect to launch some new things. I've also learned the hard way not to pre-announce. To date ourselves even more, I announced the card about a year before we were able to roll out the first version. And for a year, I was getting maligned by various members of the press, definitely not you, how this card will never happen. So I'm a lot more careful now about saying when things will ship. But the roadmap for every part of Affirm, certainly the card, is long and exciting.
Yeah, no, definitely not me, Max. I mean, come on, man. Come on, give me a break here.
You've been a great supporter.
So you have to have. I mean, I always view Affirm as a great read on the economy, and I look at these results and I have to think, so many stories that we hear about consumers still having problems with affordability. They can't put an extra thing of Tide in their baskets. Like, you are capturing this. I mean, do you still see consumers struggling to make ends meet at the end of the month?
We do not. If you look at our results, it shows that there's tremendous shopping, tremendous demand for our services. And if you look at the repayment curves, they're still going very solid. And like one of the better sort of measures of how consumers are feeling about their finances after they made a transaction with Affirm, if you go to our shareholder letter, we always publish vintage curves of our net adjusted charge-offs, which is kind of the best metric of like what happens in the end. Did you pay your bill, or did you say, sorry, I'm just going to default in this loan? And they are tightly packed curves, one on top of the other, suggesting that consumers are performing financially about as they have been for the last 5, 6, 8 quarters. So I think the news of the American demise are greatly exaggerated, if we're honest here. We don't say yes to everybody. Obviously, we're very good at underwriting. That's kind of the key secret sauce here is we are excellent at AI. We build our own models. We've always built our own models. So I'm sure I have a slightly biased view, but the Affirm consumer is healthy.
You are my go-to for all things forward-looking software. I wasn't going to say earnings there, Max. Don't worry. But forward-looking thoughts on software, Max. Just given, of course, your experience with PayPal, building Affirm. This is one heck of a moment in software where like companies that are reporting good earnings are getting slammed out of fears that Anthropic or Google are going to come out with some model update that ruins companies that are posting billions in dollars of sales overnight. What is your assessment of what's happening here?
If I could see the future, I'd probably trade the stock market instead of running a company. And not kidding. I would never do anything else. I love starting and running companies, but super sort of a hot take. I think if you're in a business of generating assets, you're going to be just fine. I guess it's very competitive. It's always competitive in every industry. Financial services, no exception. But Affirm makes assets. Our assets look like loans. They are things that yield cash flow. We have huge partner ecosystem that fund these assets, that buy these assets, that help us package them. We have literally hundreds of thousands plus partnerships with merchants that require both software integration, which is becoming cheaper and easier and better, but also complex business integration, which is helped by AI, but is certainly not a thing that you can completely outsource just yet and maybe never. And most importantly, we have a deep relationship with our consumers. 96% of all transactions come from existing consumers. And the loyalty that we've built, the brand that we've created, is a really powerful defensive mode. So if your business is just building software and you don't have a brand, you don't have a great reason to hang on to your consumers or your customers, other than it's always been there, this is the wake-up moment, because that's going to be very, very tough to defend. Our defensive mode is the relationship we have with consumers, the relationships we have with merchants, the super deep capital markets relationships that we've built over the years, and the fact that we build amazing software and amazing underwriting models, but also the fact that we put our own money to work every single second. There's 40 plus million loans every quarter. Each one of those is a test, not just of our software, but the end-to-end processes. And so we feel very, very good about the value we're creating for the ecosystem, and it will remain competitive, but better AI just allows us to build more products, more features faster. Part of why I'm so excited about the card features, a little bit giddy with how much faster we'll be able to ship all this stuff. So in that sense, it's the best time to be a software engineer.
Max, lastly, I'm just letting it sling. It's a Friday. It's been a long week. My week started with the news out of PayPal. I'm sure you saw one CEO left, another CEO in. You are viewed as the co-founder of PayPal. And my question to you is this: Can that company Can that company be saved? The Affirm's market cap and PayPal's market cap aren't exactly that far apart. Is their time just passed and they just can't pull themselves out of the hole that they're in?
I think you're asking me to compare which of my babies I like more. I think that's a rough call to make. Obviously, it is my first baby. I don't love what's happened to it in the stock market. I do think it's a great brand. I think we built something really important and lasting, and I certainly hope it has more moments in the sunshine. That said, we compete with PayPal every single day, and I don't mind having the competition being a little bit easier as far as my current baby is concerned. So I guess to answer your question, on one hand, or nostalgically, sure would be nice. In practice, I'm out to win this market, and they're a competitor. So bummer, but we're on it.
I needed this conversation to end my week. Max, always nice to see you. Affirm CEO and founder Max Levchin, always making time for me and Yahoo Finance. I appreciate it. Congrats on this quarter. We'll talk to you soon.
Thank you.
Coming up, Once Upon a Farm, the latest company going public. We're going to hear from the company's co-founders, including actress Jennifer Garner. Now time for some of today's trending tickers, starting with Biogen, the company reporting a beat on earnings and revenue for the fourth quarter. The company also sharing a 2026 profit forecast that came in above Wall Street's expectations. Biogen's guidance reflecting the boost from cost-cutting measures as sales shrink. RBC highlighting that it continues to see upside potential and they remain buyers. Next up, AutoNation reporting fourth quarter adjusted profits that topped estimates. Meanwhile, the company sees total revenue falling below expectations in the quarter. The retail auto giant pinning the decrease on lower unit sales of both new and used vehicles, offset partially by an increase in after-sales revenue. JP Morgan, however, noting the results are better than feared in context of peer results so far. And finally, Robinhood, seeing gains as the price of cryptocurrencies broadly rebound. Bitcoin climbing steadily back above 70,000 after having touched a 16-month low overnight. Yet the biggest cryptocurrency is still on track for its worst weekly performance since 2022 after wiping out all of its post-Trump election gains this week. And Jennifer Garner's Once Upon a Farm makes its public debut on the New York Stock Exchange. Yahoo Finance's Brooke DePalma gets a closer look into the children's food brand with the company's co-founders on this milestone day.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the New York Stock Exchange. And from the farm to the financial capital of the world, Once Upon a Farm made its public debut under the ticker OFRM. And I'm pleased to be joined by co-founder and CEO John Hancock, as well as co-founder Jennifer Garner. Thank you both so much for being with me this afternoon. Certainly, this is very exciting, but you guys have been on this journey for a little bit now. You both joined as co-founders in 2017, and Jen, for you, I'm sure there are so many companies who are knocking on your door to work with you. What made this opportunity so compelling?
The original founder, Cassandra Curtis and Ari Raz, were really solving a problem that I had struggled with as a mom, that you could buy organic, fresh, refrigerated food for your dog or cat, but not for your baby. So she was out there doing it with this tiny little company, the first HPP, refrigerated, organic, fresh baby food, and I just wanted to be involved. I met John. We started talking about, wow, could we be a purpose-driven company and do this together? Yeah. We shook hands on it at the end of our first meeting. I'm in if you're in, and here we are.
Yeah, I remember, John, you telling me that story this time last year. But you have taken another company public, another natural foods company, Annie's. How does this time differ from that time, just in terms of the IPO market overall, but also preparing this company from the get-go to take this move and go public?
Well, this company is quite a bit bigger than Annie's when it went public, and both in people and in revenue, and also in systems and preparation. Like, we learned a lot of things from Annie's, and we were just so well positioned to go in a much more mature company in many ways than Annie's was, with a much bigger growth opportunity ahead of us.
The IPO market, is it far different than when you took Annie's public?
I think it was significantly different. There weren't a lot of CPG companies like us at our size that went public, but that was true then, it's true now. So that's not really a big difference.
And we're at this moment in time where protein is so important. Protein, fiber, I feel like we've heard those words a million times over. Specifically though for adults, but your average consumer is about 2 to 5. So how does that sort of translate to that age group and to your core consumer, this mega trend that we're seeing?
We definitely stay close to our consumers. We have a lot of consumer insights, and we're right there with them in lockstep. I mean, as you saw with all the children here today, we're raising our kids alongside our consumers. So we know that protein is first and foremost, or at the forefront of their minds. We have 3 pillars: clean ingredients, clean whole ingredients, great taste, and wait a minute, my brain is getting so tired. What's the other one?
Great taste and
clean ingredients, great taste,
and
superior nutrition. Thank you. Sorry, it's been a long day.
Functional superior nutrition.
Functional
And
superior.
that really speaks to what we're seeing.
It does. It speaks to what we're seeing, but anything that we put out has got to be delicious, or kids aren't going to want to participate. And we also know we're not trying to raise little Gaston. We're trying to we want kids to have the developmentally appropriate amount of anything. So as we move further in the market, you'll see more of our offerings.
And kids are certainly probably the toughest critics out there, so you guys probably have that.
They'll try anything once, but if it doesn't taste amazing, not coming back.
And speaking of those offerings, with this IPO happening now, you guys already have a lineup of everything from puffs to the pouches, which you guys are very widely known for. What sort of opportunity does this provide for you, John? And when you think about the opportunity at hand within Walmart, Target, Kroger's, Wegmans, you're already in so many retailers, so what's next?
So the biggest opportunity we have is to broaden our distribution and deepen it in the categories we're already in. Like you mentioned, kid snacking over by Kid Dairy, huge opportunities there. One of the big things we're working on is putting coolers in baby aisles. So we're giving parents the opportunity to buy fresh baby food as they walk down an aisle that's usually full, most always, of ambient, shelf-stable stuff. And that's such a disruptive thing in that aisle. So that's going to be a big initiative of ours. But we're also going to take the brand through other categories that are really important to moms and dads, like things that could go in the lunchbox. You could kind of imagine like lots of places we could play with this brand with better tasting, fresher type products.
John, I do have another follow-up to that, because right now we're at this point where value is so important, especially to parents who maybe have a stretched budget. You are in this premium nutrition category. So how do you play into that while also being mindful of the price point?
So we've been really focused for a long time on using price pack architecture to make sure our average unit price is decreasing over time. So for example, moving from a single on the shelf to a 4-pack to an 8-pack to a 12-pack across channels has really allowed us to broaden our reach of the brand. And we actually do really well with the top third income households, but middle and bottom we index right to the category. We have a lot of households making less than $40K a year that are buying our product, which surprises a lot of people. And it's because they see the value in it and they're willing to, maybe look for it and they'll buy it on sale, or they'll go find it in a place where the AUP, the average unit price, is a little bit lower in a bigger pack. And we see that across our whole business.
And when you think about that price point, do most of these consumers come to you for the pouches? Is that kind of the entry point here?
It can be. We have older kids finding us on the bar aisle. So we definitely are aging up. We are a baby to big kid brand, and every year we're pushing our age up a little bit more and more because we do want to help parents. We're parents' ally. We want to help them out in the lunchbox. We all know how frustrating it is and monotonous to pack a lunch every single day. We want kids to have something they love, something that is nutritionally vibrant, and something that is going to come home eaten. There is nothing left. It's been eaten.
Yeah.
I will admit, I thought the protein bars were for adults too, so I might have indulged in one or two.
They're for everybody.
They're just actual real good food.
Yeah, and when you think about sourcing those ingredients, those clean ingredients that you guys have, about 40% does come from foreign suppliers. John, walk us through what this past year has been like in an environment where there has been tariffs, as well as so many ports blocked or closed, and also the price of that. How's that impacted your bottom line?
So tariffs have had a little bit of impact on us, and we've had to move our sourcing around. We source from multiple regions of the world and maintain relationships in each of those places so that when things like that happen, we can shift to another place. And also because if a crop fails in a country, we need to be able to get cherries or whatever it is. And so we have been able to navigate that stuff really well and expect that we'll continue to be able to do that.
Yeah, and from foreign suppliers to your family farm, right, Jen?
Yeah.
When you think about the opportunity that this has provided for your family, what can you tell us about that?
My uncle Robert had been a plumber for 40 years and became a farmer on the farm where he and my mother grew up. Early on, they supplied our company. Now they further our mission, he and my Aunt Janet, by growing tons of organic grapefruits and vegetables and taking them to the local food bank.
That's wonderful. And just last question here, when you think about the audience that you do cater to, it's parents, and maybe for the first time, a company that they really know and love is going public. So what is your message to that potential investor this afternoon?
We're going to continue to grow this business exactly the way we have before, which is by staying really rooted against our mission, which is to drive systemic change in childhood nutrition for a happier and healthier and more equitable world, with making great tasting products that are really first appeal and the happiest thing a parent can give their kid, and their kids are going to love it. We're going to keep doing the same thing. The public markets give us an opportunity to do that on a bigger stage, but that's how we're going to continue to grow, is by not changing, not veering from our mission at all.
Well, congratulations to you both on the IPO. Thank you so much for taking the time. Appreciate it.
For chatting with us.
Of course. Back to you guys in the studio.
A new report from PayScale is finding that more employers are moving away from merit-based raises and annual performance reviews, opting instead for standardized pay increases. For more, we're bringing in Yahoo Finance senior columnist Carrie Hannon. Carrie, great to see you. What are the details here?
Hey, great to see you, Jared. This is a concept that, first of all, to start off, the 3.5% raises for 2026 is pretty much on par with last year. So not terrific, but certainly worth noting, and that's not a bad thing, and that varies by industry and so forth. But in size of company, the smaller companies tend to have slightly larger raises in certain industries. But Jared, the big news here today is what that pay scale is. It came out of their report there. They study compensation data, and they use this term peanut butter style raises, which means that it's not based on your performance, your raise in 2026, but on an evenly spread amount, say that 3.5%, right across everyone. So there's no differentiation. If you really crushed it in your job last year, that doesn't mean it's going to be reflected in your pay raise this year. So I think there's a little, it makes workers maybe feel a little bit anxious about that to a certain degree, or feel undervalued. But for employers, this whole idea of tying a raise to the merit or your performance review can be kind of a tricky territory. I mean, the complaints are it's biased in a way, it's very subjective, and there's a lot of, sort of anger that came up from those. And so in today's world where budgets are tight, and the economy is volatile, I think employers are simply saying, we're taking the messiness out of this. We're going to make it simple. We're going to go across the board this way. The ones that have chosen to do that, and according to PayScale, an increasing number this year are following this mode, not merit-based, but across the board standard raise. Than have in recent years, and they expect to see more of this moving forward. So I think this is one way to kind of deal with that, and it also gives them a sense of not feeling like they're just cherry picking certain performers. Now they have other buckets that they can reward people with, certainly bonuses and other things like that. But Jared, it is sort of the peanut butter spread evenly approach is getting a lot of attention.
Yeah, I'm kind of stuck on that metaphor because I remember getting paid for chores as a kid in peanut butter and jelly sandwiches, so very appropriate. Do you have another question? What about workers then who are feeling undervalued? How can they stay motivated?
Yeah, Jared, that's a great question, because that's what I'm hearing from workers. They're like, oh my gosh, I can't believe that, I'm getting the same raise that, 2 cubicles down, this guy hasn't really been doing the job I have. And what people can do is, okay, just take it easy. You may very well get compensated in other ways, so be patient. In the performance reviews, instead of basing it on your performance review, you're going to expect to have more of those throughout the year. That's when you can be making your case to your manager that you really are a top performer. But a couple of things you can do right off the bat to get you psyched up about getting to work, because if you're feeling kind of unmotivated and undervalued, go learn something new. The career coaches I talked to said that's often the best thing you can do, is add a skill, constantly be learning something new. It gets you excited about your work and learning something new, and also find ways to fit that into the job you're doing right now. Then you're adding value to yourself and psychologically, it's a really bump for you as well. The other thing you can do is, check it out. Like, what does your boss need to succeed? And if you can find ways to help out your boss and make them look good, trust me, that's going to come back and reflect on you at some point throughout the year.
Excellent advice. Always great talking with you, Carrie.
Nice to see you.
And we are wrapping up today's Market Domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.